Yes, yes, yes. Private equity investors are willing to work long hours because they get paid a lot of money. That may be the reason why PE investors are internally motivated to work hard, but there are a lot of external factors that make the job so demanding. And so today we're going to be going over the 5 key reasons PE investors work the long hours that they do, and they actually build on top of each other, so make sure to stick to the end of the video and you'll understand why if investment banking is like playing in D1 college, PE is like playing in the NBA. Jumping straight into it, the first reason you work long hours in private equity is the embedded culture within the industry. Almost all private equity investors come from investment banking, which is notorious for its 80 to 100-hour work weeks. And so this means that as a baseline, PE investors know how to grind and are used to it. And this includes everyone from the juniors to the seniors. And this is significant because companies are the long shadows of their leaders. And so if your partners have grinded working 70 to 100-hour work weeks as juniors, then they're going to expect you to as well. This sort of culture is just seen as the norm and sometimes even a measure of dedication. And even though PE hours are generally better than in banking, they can be a lot worse during the worst of times because you're still working the same 90 to 100-hour work weeks, but with more pressure and stress, which we're going to talk about in the next 4 reasons. Now, if you're watching this because you're interested in breaking into private equity, you're definitely going to want to check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North American PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and if you sign up by the early registration deadline, you'll get $200 off. And be sure to use my code rareliquid to get an additional $300 off the program. And I'll leave information for everything I just discussed in this video's description. The second reason PE investors work long hours are the high expectations and pressure from their limited partners or LPs. LPs who have given PE investors millions to billions of dollars to invest for them expect consistent long-term returns above the stock market, which is simply one of the hardest things to do in the business world, especially given the method PE investors use of buying out entire companies with debt, improving their operations, and selling them, all while battling competition, economic changes, and unforeseen headwinds. An infinite number of small and large things can go wrong throughout this whole process, and so you really have to analyze your potential investments extremely thoroughly, manage your existing investments well, and sell ideally when the markets are hot. And all of these things are extremely hard to do, and if you make any mistakes, it could easily cost your firm millions of dollars and potentially billions if you have poor performance and you can't raise your next fund from investors. The third reason has to do with lean deal teams. At most, there is 1 junior associate, 1 senior associate, 1 principal, 1 VP, 1 MD, and 1 partner on each deal, which totals to 6 people, but it's also possible that there's only 1 associate and 2 seniors, so the deal team could be as small as 3. This is why private equity firms are extremely selective with their hires, and as a PE investor, you truly have no place to hide. And so when you're working on a live deal, you've got a ton of responsibility and you're leading so many work streams, as we'll discuss later, that you really have no choice but to work late. The fourth reason is the intense nature of deal cycles. Speaking from experience, every live M&A process is extremely time sensitive because sellers want to create a sense of urgency and also a competitive process. And there's also a lot of confidential information being sent around. And so the sellers want to get everything done cleanly and quickly. As a result, PE investors are always up against the clock when analyzing potential investments because they're always at risk of losing a deal if they don't put in a bid, since others in the bidding process might take the opportunity away from them. Now, to be fair, PE investors are notoriously patient and disciplined, so the good ones won't overpay for companies, but regardless, they still need to go through these intensely time-sensitive M&A processes. Last but not least, reason number 5 is the crazy amount of work streams PE investors are in charge of while needing to maintain precision and perfection. Remember that in PE, you're putting millions to billions of real dollars into companies, and so in order to feel good about a potential investment, PE investors have to dissect a company's financials by product, customer type, and/or geographical location, sometimes to the city level. Work with lawyers in order to review existing contracts. Work with banks to get the best interest rates possible to fund the transaction with debt. Work with accounting firms to make sure the company's books are all legit. Speak with industry experts and consultants to get a sense of the company's competitive position in the market. Interview key customers to gather firsthand feedback. Dig into IT systems to test the company's infrastructure. Build a detailed LBO and valuation models to determine a good price to enter at. And put all of this and more into what are called investment memos that present an investment opportunity in the form of a Word doc. A lot of this information will come in the form of data rooms, which are kind of like Dropbox folders with tens to hundreds of Word docs, PDFs, PowerPoints, and Excel files that PE investors have to shift through in order to identify key risks and opportunities. And I remember back at JP Morgan when I used to help sell companies, I would manage the data rooms and always think, damn, there's so much here. It really sucks for the people who have to go through all of this. And as a PE investor, on a small deal team, you're not even splitting it up with a ton of people, so there's so much to look through. The crazy part of all this is that you also have to maintain perfection and precision. You can't make any major mistakes in your financial models or miss a key risk because any mistake could easily cost the firm millions of dollars. And very importantly, no one is there to check your work. While senior PE investors will be looking at your deliverables and question things that look off, whereas in banking, all work that an analyst does gets checked by an associate before sending it off to senior bankers. In private equity, you as the associate send things directly to senior PE investors, so there's a lot of pressure in the work that you do. Now, in addition to analyzing potential investments, you'll also have to manage your portfolio companies by supporting FP&A work, or if things are going really poorly, then almost all your time could be spent on helping improve operations. So in sum, because PE investors come from banking, there's so much money on the line and pressure from LPs. Deal teams are super lean, deal cycles are short and intense, and because you have an endless number of responsibilities that require precision, you end up working those ungodly 80 to 100-hour work weeks during the thick of things in private equity. I'm guessing you're interested in the private equity industry and that's why you clicked on this video. And if you are, you may first need to break into investment banking. And on that note, I've been building out my own how to get into investment banking course that is going to provide everything you need to know to break into the industry. And so feel free to check that out in this video's description if you'd like. Lastly, in the next screen, you're going to see a video about the good, the bad, and the ugly aspects of private equity. So feel free to check that out. With that said, thank you guys all so much for watching and hope to catch you all in the next video. Thanks guys.